You're listening to the Reinvest Podcast, where each Tuesday we will show you how to reclaim, reconnect, and refocus your life by bringing you the top real estate professionals in the industry. We'll pull back the curtain so you can implement these tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo. Well, thank you guys for joining us here on episode 33 of the Reinvest Podcast, where Seth and I get to show you how to maximize your life through the power of real estate investing. At this point, we're on YouTube now.
Yes.
We've made it.
Yes, so make sure you check out our YouTube channel and give us a subscribe and like on the videos if they add value to your life. And go back and listen to the previous ones we've released.
We're all about honest feedback, so if you have anything less than a 5-star review, keep it to yourself. And now we're excited to be at this point. Started this little over a year ago. Yeah, from the Best Ever Conference. So, and actually, our guest today, Jim Pfeifer from Left Field Investors. Jim, how you doing?
I'm doing great.
Had a chance to see you in passing at the Best Ever Conference this last year. So
yeah, that was fantastic. I was glad to be there. I met a ton of people. It's a great conference.
Had you been there before?
No, but we are going back. That was our first time. You know, we just kind of we went to the IIREC in 2022, and we decided we were going to try one conference a year, and so we picked Best Ever for this year. But we'll be going back for sure. It's fantastic. Great way to meet a lot of people.
It's a good blend of both active and passive investors. I think they do a good job of catering to both and kind of building a bridge between the two to network. And you guys are located in our backyard, which technically we're the small players. So yeah, we're in your backyard in Columbus. So you guys are in Columbus, is that right?
Yeah, I mean, we're kind of virtual because we have members all over the country and, in fact, all over the world. But 4 of the 5 founders of Left Field Investors are located in Columbus. Yeah,
and we're located in a slightly smaller city, Lima, almost as big as Columbus.
Close, it's close. Yeah, we got some mad population growth.
That's right.
So it's been interesting. You know, part of the purpose of today's episode is over the last few years in the real estate industry, syndication has really taken off. The verbiage, it's been, a buzzword in a lot of people's vernacular. And essentially, more real estate investment opportunities opening up to people from all walks of life, accredited investors and non-accredited investors. And with that, though, anytime you have kind of a barrier to entry that, is limited, or reduced, you have an influx of people that pour into that segment. And so then there's lots of different options and operators out there now for people who are looking to place capital. And Jim, you guys have created a community at Left Field Investors. You yourself have been a passive investor. And what I want to focus on today is how do you vet somebody who maybe is an active investor to make an educated decision and put your capital in something that's a good investment vehicle. But first, tell us a little bit about Left Field Investors.
Sure. Left Field Investors was not created intentionally, as lots of things that I do. We started this as going to be a little 12-person dinner club in Columbus, Ohio, to just a mastermind to talk passive investing. Our first meeting was March 18th, 2020. And you guys are from Ohio, so that was the week that Ohio shut down for the pandemic. So we had to go online, and it just blew up from there. We now have, we went from 12 members to now we're almost at 1,300.
Wow.
And our mission is to provide education, networking, and deal flow to passive investors. And we are passionate about educating people that this is possible, that you don't have to be just in the stock market or just throwing money in your 401k. There are other ways to invest. And, a lot of people think alternative investing is scary. What I tell them is it's where you live. It's where you go to work. It's where you go to vacation. It's where you go to dinner. It's where you stay. It's real estate. It's all these things. And it's not scary. And so, our mission is to share that and share with people that, hey, you can do this. You can invest in real estate too. And we kind of help you figure out how to do it and be comfortable with it.
So where'd the name Left Field Investors come from? What was the inception of that name?
Yeah, so, we were talking offline a little bit. Everybody thinks we're really into baseball. And what we are is we're really into using baseball and the terminology to name our group, I guess. But I'm a former financial advisor, and my colleagues would always tell me, when I talked about real estate and alternatives, they would always say, "Oh, Jim, you're way out there in left field." And so that's kind of, then when we were thinking, hey, we need to change our name, because our original name was Columbus Passive Investing Group. And when you do the initials on that, it's CPIG, which is not the greatest brand name. So when we kind of figured out that this was a business that could last, and we had, we were growing pretty fast, we changed the name and came up with Left Field Investors.
I will say you would not forget the acronym CPIG.
No, you would not.
It does have checks the catchy box of marketing. So
right.
Just to kind of like maybe walk through that a little bit slower, you had a group of 12 individuals or couples, kind of a group of people that had the alignment of interest to say that we would like to explore investing as a group. And you began to evaluate different investment opportunities?
Well, so we weren't going to invest together initially. It was kind of like a mastermind. I knew that I was really getting into passive investing, and I was an active investor before that. And I started a group that, we had 20 or no, actually, I think the last couple of meetings, we had maybe 60 or 80 people come to our an in-person meeting to talk about active investing. And when I was transitioning from active to passive, I wanted the same kind of thing, because it gives you confidence, right? Especially with passive investing in real estate. These syndications, right? They're long-term investments. They are illiquid, and they're completely out of your control. And so, we're going to talk about this, but when you're trying to find who to invest and who to put your money with, it's really scary, because there aren't, there's no, how do you know, right? You're not going to know for 5 years if the deal went well. So one of the first people I met, he's one of the founders of Left Field Investors, Steve Sue. I remember when he told me, hey, I've invested with this sponsor, and I had invested with the same sponsor, and the sense of relief I got from the confidence that he gave me that, hey, here's a smart guy. He's a doctor. He's invested in the same sponsors I had. I was like, okay, this might be real. I didn't just wire my money to some random guy who's going to run off with it. And so that's kind of how it started, is I want more of this. I want to gain confidence. I want to educate myself and others. And so that was really how it started. We just wanted to have a place to go and share information, because if you walk out your front door and you talk to your neighbors about finance, they're going to talk 401k, IRA, what's the interest rate on your mortgage?
Right.
And then you're going to say alternatives, and they're going to run for the hills. Like, who's this nut job? So that's kind of why we started the little mastermind that grew into a community.
So are you full-time in this now?
Yeah, I have been since 2020, since we started.
Okay.
Because I was a full-time passive investor when I started the group.
Okay.
Now I'm a full-time, I lead the community, and I don't have nearly as much time to do my own investments. But yeah, this has grown into a full-time job. And as a matter of fact, one of our other founders just quit his W-2 and went full-time with Left Field Investors as well.
Wow.
So Chad Ackerman is also full-time. So we're really thrilled about that.
Very cool. So prior to you maybe going full-time passive investing and before, full-time Left Field, you said you were a financial advisor. Was that kind of your 9 to 5 before you started jumping into real estate? Or what was life before real estate? And you said even you did active real estate for a while. And what did that look like?
So I've done a number of different careers, and real estate started a little bit before I became a financial advisor. I was actually a high school teacher, and we were accidental landlords because we built a house in 2008 and we couldn't sell our old house.
That's a good
and
time.
We moved. Yeah, right. And so we rented that house for 5 years, and I absolutely hated it because I was the property manager, and we had great tenants. He made me take my shoes off before I walked into my house, which thank you, but also it's my house. But I hated being a landlord. So I was done with it, and I was going to sell the property. And I went to my realtor, and he said, well, how about this? I know he knew the property was paid off. And he said, how about I manage it for you, because you hate that, and you get a loan on it and we'll buy you 2 more houses. And so I converted one asset that was not optimally performing because I didn't have leverage on it, converted it into 3 cash flowing assets. And at the same time I did that, I was training to become a financial advisor. And I was a finance major in college. I'd always been a stock market guy. And so what they do when you start as a financial advisor, they reteach you everything you need to know about money and finance and all that. And as they were teaching me that, I was a real estate investor on the side. And the more I learned about money, the more I thought, these paper assets, that's speculation. That's not investing.
Wow.
And real estate is where it's at. So I always prided myself as a financial advisor that I put my clients into the same investments I was doing. And slowly I started doing more real estate, but I couldn't put them in that because, one, I'm not licensed for it. Two, I don't get paid for it. So, there's no incentive for a financial advisor to help you get into real estate. So soon I learned that, I wanted to be consistent and get my clients in the same things I was doing. And that's when I quit being a financial advisor and went full-time into active investing, which I was not very good at, but I didn't know it yet.
I could see you like kind of in the office around some of your financial planner buddies, and you're like slipping out to take a discreet phone call with your realtor, like, yeah, they're like, hey, who was that? Oh, nobody. It's kind of, because real estate's kind of a dirty word, like for somebody who's been very ingrained to kind of work mutual funds and, all of that stuff. Right.
Yeah. Yeah. And I don't want to get off track here, but we have a term that we've kind of come up with, community personal finance, right? So we think that there are 3 different types of personal finance. One is traditional personal finance, right? That's the stock market, IRAs, all of that kind of stuff. And there's a place for that, maybe. But the thing about traditional finance is it's easy because you just open up a brokerage account and go, or you just throw money in your 401k. Everyone's doing it, so it's not scary, right? But the returns aren't that great if you compare them to what we're doing. And it's highly taxed. And the biggest eroder of wealth is taxes. So that's not really the best place to be, but it is the easiest. Then you have alternatives. That's really hard and scary because, you're putting large chunks of money into investments or in syndications. You're putting it with people you don't know, and it's super scary, and people don't understand it. But the returns are much better, and the tax treatment is much better.
Right.
So what is community personal finance is the alternative investment where your community helps you, right? So now if you have a community that is teaching you how to get into these investments, that's sharing sponsors and deals with you, now all of a sudden you have the education, you have the confidence, and then you can get into alternatives in a safer way. So what we look at is community personal finance is alternative investing with help of your community so that you can do it in a safe manner that is gives you confidence.
It demystifies maybe a lot of false notions or even partial truths that people have about real estate because, to your point, they haven't been educated or they lack the confidence. One thing that struck me too is that people don't even know what seats on the bus are available for them to sit in. They think they have to be the property owner taking the phone call of the single family house. And in today's economy, there are so many ways to get involved in real estate that it's kind of mind-numbing, honestly, but exciting. You alluded to the fact that you weren't a great active investor. Just looking at your success with left field investors, you're probably a better passive investor, and it seems like you're doing a good job educating people from that seat and that lens.
So how many deals have you been in as an LP, as a limited partner, you think?
It's hard to say because we use a company called TribeVest, and those are smaller investments. So when I say the number, it's going to be like, oh my gosh, it's probably over 100. But a good portion of those are deals where I go in and invest with a group. So if we're investing $50,000 in a deal, I may be only a 10% owner of that LLC, so I'm only investing $5,000. So I would guess somewhere around 50. Personally, and another 50 or so through these tribes that we do with TribeVest.
Yeah, that's pretty incredible. And I know what you're saying, because with TribeVest, it may not be a $50,000 minimum. It gives you the ability to kind of monitor the size and diversify a little differently than what traditional LP slots are.
Yes.
But over the course of that's a lot of reps. That's a lot of pro formas. That's a lot of pitch decks. That's a lot of, all of the documentation that is given to you by an active investor that you've laid eyes on. And those are just the ones that you went forward with. Forget all the ones that you said no to. So really what we want to dive in today is how do you vet a good investment opportunity for somebody out there that says, Jim, I've got money. I've wanted to get into real estate for years. I think I'm ready to get off the sidelines. And now I realize there's a spot for me to do that and a way to do it where I don't have to be signed on the debt or, fill in the blank that way. So what have been some of the hard lessons that you've learned as a limited partner over the different investments you've participated in?
Well, the one thing I've learned is the most important thing when you're looking at a deal is the operator, the sponsor, the operator, the GP, whatever word you want to call them. That by far is the first thing I look at. It's the last thing I look at, and it's probably the thing I look at in the middle. It is so important because you can have the greatest deal, but if you don't know how to operate it, it's going to stink. And I can tell you that because I wasn't good at it, as I said. Now, I made money on all of my active investments because it was hard to lose money the last 5 to 10 years, right? Even someone who wasn't a very good asset manager, everything went up. Now, nothing cash flowed on my active investments like it was supposed to, except those first deals that I was in that I was telling you about. All the other ones, they didn't cash flow. And so what I realized is I need to hire quality asset managers because I was spending all of my time messing with the property manager, trying to don't evict this guy, evict that guy, all this stuff. It was terrible. And finding quality property managers was an issue. And so I decided I'm going to start hiring asset managers. They do this professionally. That's all they do. And so I'm going to hire them and they're going to manage the asset for me. So the key is to pick the right operators. And I think it might be helpful to go back in time and show you how I used to do it, how I evolved, and now how I'm doing it now, because I started out doing it really poorly. Then I found a way to do it that was average. And now I found a way that I'm pretty confident is maybe the best way to do it. Maybe I'll learn a better way. Hopefully I will. But for now, it's the best way. So going back, when I first found syndications, right, that's passive investing in these real estate deals, I went to a real estate guy's syndication seminar. And I thought because I was still an active investor, I thought I'm going to go in there and learn how to be a syndicator and make a bunch of money because I'm a great asset manager, because I hadn't figured it out yet. And I was at that conference for maybe 10 minutes. And I thought, oh, wow, you can be on the other side of this. You can be a limited partner. That's me. And that's kind of when the light bulb went off. But what I did was I had an old 401k that I put into a self-directed IRA, burning a hole in my pocket. And I had just found out that I could use it for real estate. So I thought, I'm at a conference. Surely anybody who's here has to be like the best of the best operators. So I just walked around shaking hands, throwing money, right? I was like, hey, are you an operator? Here's $100,000. Here's $50,000, and it was really stupid. But I didn't know it at the time. And so some of those deals turned out okay. One deal we'll probably talk about later turned out bad. And the rest were fine. I still have a lot of those investments and they have not panned out as I thought they would, but they're not killing me. So that was some of the retirement money. So I thought, I have some time for that and it'll be okay. So that's kind of it was a bad plan. So
that turned out to be an expensive trip.
Yes, you're right. And that's funny you say that because it took me so long to pull the trigger on that because I didn't realize that I was starting a business as a passive investor.
Right.
And at the time, I didn't want to spend $300 for a hotel and $500 for a flight and $1,000 for a conference. I thought, what am I doing spending all this money on a conference? Because, I used to be in the corporate world where they would send you on these conferences.
Right.
But I'm really glad that I went because this was the start of my journey. And yeah, I made some mistakes. They didn't kill me. Everything was okay. But I knew I needed a better way. So my second version of finding the quality operators was I just listened to a ton of podcasts. Mm-hmm. I read books and I listened to podcasts. And when I heard someone on a podcast that was an operator, I would email them and set up a time to talk and we'd have a conversation. So I would talk to this operator for 30 minutes and learn everything I could about them. I had a whole list of questions. Then they would send me a deal and maybe I'd get on the phone and ask them some questions about the deal. So maybe I'd talk to this person for a full hour over, a period of time. And then I would have to decide, am I going to send this person $50,000? Right? I've talked to them for an hour. I don't know if they're a great operator or are they just a great podcaster? Are they a great marketer? I have no idea because I've just talked to them. That's all I had. And so my results were a lot better there because a lot of them were good operators. And I made a lot of good connections, but I still wasn't sure because as we talked about earlier, these are long-term illiquid investments out of your control. You're not going to know for 5 years if the deal was any good.
Right.
So how do you make that decision? So then I pivoted to the third way, and this is how I do it now. I do not invest with an operator that's new to me unless they're referred to me by someone in my community who I know, like, and trust, who has already invested with that operator. Wow. Now, that doesn't mean they have to have gone full cycle. It means they've invested with them. They've either gotten reports, gotten distribution, something to tell you, hey, this is legit. We wired money there and there's a real person there and that person bought something real estate with it and is now sending you cash. Like, okay. And so what that gives you is I still do all the same due diligence on the sponsor. I still ask them all the questions. I do all of that stuff. But now I'm starting from a position of trust,
right?
And trust transfers, right? If you trust me and I trust Steve, then you're going to trust Steve, at least initially, enough to vet him. So now that's how I do it. And that's why when people ask me what's the most important thing to do if you're getting into passive investing, I say join a community. It doesn't have to be left field investors. There's lots of communities out there. I think ours is great. I'm completely biased, so don't listen to me. But join a community, because how else are you going to get this knowledge? You need a network, because you can't turn on the TV and get advertised from Wall Street on this stuff. You can't find it. It's hard to find these investments, and it's hard to find the operators because there's all kinds of rules saying, hey, you can't advertise. You can't be public about it. So my thing is join a community and learn or meet people, right? Get to know them and then ask them, hey, who are you investing with? And that's how you find new operators. And that is the most important thing, I think, of being a passive investor.
So really kind of adding in the referral component as a criteria before you move forward with an investor. And it is weird. The psychology of that is kind of strange. That whole trust transfers principle. If you think about it too hard, it kind of freaks you out. Like you say, hey, let's just say I had $50,000 ready to deploy, and I ask you on this podcast, you're like, well, here's one of my favorite operators. Immediately, I might omit or lax up on the rest of my approach in the conversation with that investor because of your opinion. And I'm sure you guys are very selective then as a community before you put a stamp of approval on somebody, because so many people are looking to you okay, what do you guys think?
Yeah, and that's a great point. And that is exactly the reason why we do not put any stamps of approval on anybody. What we are, so we're a do-it-yourself network with lots of help. So we provide the education, we provide the network, we provide deal flow. We even have preferred partners, right? These are partners that we know, like, and trust, but we don't recommend that. We don't say, hey, go invest with these. When someone asks me who my favorite sponsors are, I say I don't have a favorite sponsor, but here's some sponsors I've invested multiple times with, because that tells you all you need to know, right? If someone's investing multiple times. But you're right, because of my position as the leader of left field investors, if I go out and say, hey, ABC syndicator's awesome, there's going to be a bunch of people that invest in that operator just because I said that, which I don't want that to happen, because who knows, maybe I'm not that good at this, right? And we have a forum where we post, everybody, the community just has dialogue in this forum. And I used to post deals I was looking at and deals that I liked, but I realized that people gave me this credibility that I really haven't earned, but it's just because, hey, I run this community, that guy must know everything.
It's so
and
scary.
I do the same thing. I do the same thing to others, right? There's some people that if they tell me, hey, I'm investing in this deal, I'll be like, I'm in, right?
Yep.
So you got to be careful at that. And that's why at Left Field Investors, we try very hard to not be biased, right? We provide education and deal flow and a network. But if you come to us and say, hey, who should we invest in? You're going to get crickets from the leaders of the community. Right. If you say that in our forum, you'll get a ton of responses from the community members. And so when we turn community into a verb, that's what we mean. So there's a new operator, a new sponsor. Well, we're going to community that sponsor, meaning our community is going to share their thoughts and ideas and who trusts them and who doesn't and why and our experience. And that's why, it's the same thing when a new deal comes up. We're going to community that deal, meaning we already know the sponsor maybe, but then everyone in our community is going to discuss the deal and talk about it and figure out, hey, is this a good deal for the community? And so that's the power of community, right? Yeah. It's being able to use the community to vet operators, analyze deals, and just everyone becomes a better investor that way. But you bring up a good point. I wouldn't rely on just one person's advice in the trust transfers part. It's trust transfers. So now you're opening the door. I will talk to this operator because I got a recommendation, not I'm going to invest because I got and it's a distinction, but I'm glad you brought it up.
Well, and I think the whole mindset behind, people wanting to invest in alternative, investment vehicles like this already you're taking more ownership over your finances, and you intentionally thinking through how and when and where you want to deploy that capital and for what purpose. So I think many people already come with, I'm doing my homework even to get to this point. So do it the rest of the way, from start to finish, follow it through. So one of the things that I wanted to ask you was, this is kind of an interesting question. Would you invest again with an operator that did not deliver on the pro forma that they initially promoted?
Absolutely. Absolutely, I would, but only under certain conditions. So that's a great question, by the way. So if an operator sends a deal and the pro forma is whatever, and they don't meet it, and they haven't been communicating to me, they haven't told me the problems, they haven't told me the issues, and I've been asking them questions and they haven't been responding, or however that goes. If you're not communicating with me, doesn't matter. You can double the pro forma. I'm not coming back if I don't know what's happening with my money.
Wow.
So, but if something happened, like let's say there's a pandemic, or let's say interest rates go up 4%,
something real crazy and hypothetical like that.
Yeah, these things would never happen, guys. It would never happen. But if something like that were to happen, and they're communicating with me the whole way, saying, "Look, we didn't bake into our pro forma that interest rates were going to go up 4% in a year because it's never happened before." And if I can't look at them and say, "Well, yeah, I predicted that, right? I knew it was going to. Right. I didn't know either. So how can I expect them to know? Like, I expect them to know the stuff in their deal, but macroeconomics, like, they should know stuff, but they're not going to be able to predict those things.
Right.
So yeah, I would absolutely, as long as they're communicating and saying, here's what happened, here's why we projected, 8% annual returns and we only gave you 6. Here's the reasons. Here's what happened. Here's what we're doing to make sure it doesn't happen again. We've learned and all that. Yeah, I would absolutely invest again. Now, if they're just ghosting me and I don't hear from them and they just return capital and it's half of what they should have sent me back, I'm out. Or same way, if I've been emailing them, calling them, texting them, trying to get a hold of them, and they return triple my capital when I was only expecting double, I probably wouldn't invest again, because I get stressed out if I don't know what's happening with the deals. I just need communication. And that's one of the biggest things I screen for after I find a referral from someone I know, like, and trust. The next thing I test is, are you going to communicate with me before I send you money? Because if you don't communicate properly and effectively with me before I send you money, there's no chance you're going to do that once you have my 50 grand or 100 grand.
Right.
So
that's a good point.
Wow. Yeah. So, hopefully you're writing down notes.
So outside, maybe, the community referrals, the community referrals, communication, what's like another big thing that you look for when you're looking to invest with someone, or what would maybe be a big red flag outside of those things?
Well, one thing to look for, I think, is track record. And I'm careful with this one because I don't want to miss somebody new that's coming up, right? I want to give opportunities to them. I might just take a smaller swing, but track record's important. Like, how did you do through different markets, and how are you doing now? So I like to see a few exits and things like that. As far as red flags, I think red flags are something where the operator is into something new, a new asset class. That's a red flag. It doesn't mean don't invest. It means ask a bunch of questions. Or if they're, there's been some people who use the word guarantee. That's a red flag, which means I'm done. I'm out. I see you later. If you're going to guarantee me something, I know that's not going to happen. Another red flag for me is talking to someone who is 100% confident they know what's going to happen in the macro environment. That person I'm running away from too, because you know what? I don't know if we're at the top of the market, the bottom of the market, or the middle of the market. And to be honest, nobody else does either. And if they tell you they do, they have no clue. Right. So I want someone who is self-aware enough to know that they don't know everything. If you know everything, I'm out.
I think what's interesting, because we've done a couple of active investments, and it's just a real struggle, right? It's a very human problem of wanting to portray yourself as, you want to establish credibility with somebody, especially if you're starting out. And that's a fine line of coming with confidence to say, listen, we are going to get this done. And our alignments, like our interests are aligned. We're committed to this. We're invested in this. And then kind of stepping over into maybe overconfidence or kind of
trying to oversell it.
Yeah.
Yeah, I know exactly what you're talking about. And it's a dangerous place to be sometimes.
But you can be confident and say that here's how you think it will go without saying here's how it is going to go. Here is what's going to happen. And it's a distinction. It's a fine line. But the thing is, yes, you want someone who's confident that they have a good business plan and they can execute it. But they also have to be able to say, hey, there are things that could happen. This is risk, right? This is why you're getting these great returns, is because there is risk, and not all deals are going to work out. And that's one thing that we've been telling our community, because for the last 5 to 10 years, almost every deal went great, right? So people are used to every deal going well. And what I try to tell people is, look, 1 out of 10 deals, it's not going to go well for you. And if you're not comfortable with that, don't take the risk.
Right.
One. Number two, go look at your 401k, because how is that doing? So if you can't handle risk there, you're not going to handle risk in real estate, because real estate values don't really go down as much, and certainly not as fast as the stock market. So if you're complaining about someone stopped distributions on your cash flow on your real estate deal to protect the investment, and you're mad about that, but you're fine with your 401k that just took a 30% dive,
right,
I would say you need to kind of think that through.
Yeah, that's a good point.
Oh, man. I think one thing a lot of active investors, and even people like yourself, and you're kind of a co-GP of sorts. I mean, I'm not sure that you would consider yourself that, or left field investors, but you're bringing and you're fostering investment. I know that you're, from a disclosure standpoint, you're like, hey, we don't recommend, we don't stamp, but there's people out there where they have limited partners that come with them into deals, right? And everybody who is the one that has an active role in finding these investments has to manage expectations of limited investors. Because like you said, over the last, 5 to 10 years, if you just got in, you think that's normal. It's like we're full-time real estate agents. So we thought the market was normal during COVID and all of that, so record home prices. And now everybody's scratching their head, be like, what's happening? The bottom of the economy's falling out, and you're like, no, things are just normalizing. And so we are talking internally as a team. How do we approach our investors and manage expectations to say, listen, we don't know what's ahead. You might not see the returns, that we saw in the last 5 years. Things aren't going to go full cycle in 18 months anymore. It's going to take a longer time, and we're actually going to have to execute on the trajectory and the timeline that we outlined. And because then if they disagree with that and they're like, well, I don't want to be a part of it, then good to have that conversation now versus later when they're like, hey, you misrepresented something to me. And it's like, man, if I did anything wrong, I didn't set the expectation right for you.
Right. And that's important, the expectation setting. A good example of that is, I just mentioned it in passing, but there's quite a few operators who are withholding distributions now. And people in our community and other people I'm talking to, they get pretty fired up about that. And the way I look at it is, thank you. Thank you for withholding distributions, because what that tells me is you're analyzing your business, you're looking at your deal, and you're saying, wait a second, interest rates just went through the roof. Insurance costs are skyrocketing. I want to make sure I don't have to sell this deal in distress.
Yeah.
I want to make sure I don't need to do a capital call. So I'm going to be conservative and hold your cash, and I'll get it to you later.
Right.
I would much rather have that than someone who is paying me even though they can't afford to pay me, and then the deal goes south. But it is managing expectations and communicating, saying, look, we're holding distributions. Here's why. And a lot of these operators, they're not doing a very good job of explaining it. So then it becomes panic. Well, hold on a second. For the last 5 years, I've always gotten distributions, no matter what. Well, you know what? Distributions, I was talking to another operator, distributions are not meant to be regular. They're meant, that's why they call it a pref, right? It's going to catch up because they're not expecting to always give it to you. And what people are used to is 7% pref means you get 3% to 5% in the first year, 8% in the second year, and then the deal sells, even though it was on a 5-year pro forma, right? That's what people are used to.
Right.
So you got to say, that world's gone. It's not coming back anytime soon.
Yep.
We can still make money. This is still a good investment. It's better than the other stuff, but it's not like it was before.
Yep, that's good.
We're going to move into our smaller pocket segment. So, Jim, go ahead and tell us about one of your worst deals in real estate And then what did you learn from it?
So there's a couple, unfortunately, but the one of them was there's an operator who's doing turnkey single family homes in Dallas, and he came highly recommended. And I met him. I'm like, yeah, these guys, they know what they're doing. But the market in Dallas had changed, so it no longer made sense to do single family turnkeys. So they decided they were going to do small office building rehabs and get into CBD equipment, because CBD was super popular at this time. Everyone wanted into CBD.
Right.
So I was like, hey, that makes sense. CBD is popular. And you did single family homes. There's no difference between that and an office. So here you go. Here's my money. And it did not go well, right? It's one of the few investments. It was actually a loan, not even equity. It's one of the few investments that I didn't get all of my capital back.
Wow.
And that you're not expecting that, right? So I was pretty upset. But when I look back on it, what did I learn? I'm not going to be anyone's guinea pig. And there's some caveats, but I don't want to be your guinea pig. So if you are an operator who's getting into a new asset class, I'm out. I want nothing to do with it. I will watch it and see how you do. And in a couple of years, if you have success there, then I'll jump back in and have another conversation with you. Maybe I will. The caveat is, if you're getting into a new asset class and you're a successful operator with a full business, like you have a business, you're not just a fly by night. And this guy was a little bit fly by night. Like, you have infrastructure in your business, and you change asset classes, and you hire people who have experience in those asset classes and have done it for years. Then I will watch you for a shorter amount of time, and I might get in your second or third deal, but I'm still probably not getting in your first deal unless it's with a very small amount of capital. Right. So the lesson is, you don't want to be anybody's guinea pig. If someone's going into a new market, a new asset class, anything like that, you want to double your due diligence and probably stand on the sidelines, or at least make sure that they're bringing in people that know what they're doing. For example, there's another operator now who had great success in one market. They were all in one market, and they changed and went to a new market. And I was nervous, but you know what they did? They bought office space. The main operator bought a house in the new market. They hired 6 new staff or 10 new staff or something in the new market, including the people that were going to find the properties and have the relationships. And so they put so much into that decision and so much infrastructure behind it. Right. I thought, okay, I'll dip my toe in because I have confidence that you've done all the right things. So, I don't want to be anyone's guinea pig, but sometimes I will be. So how's that for a solid answer?
Yeah, no, that's good.
No, that's good. All right, man, we're going to go into what we call our little nugget. So this is the part of our show where you give our listeners one practical takeaway or piece of advice that they can implement to their real estate investing businesses.
And this, I talk about it all the time. I've already said it in this podcast, so I'm sorry to be repetitive. But if you are going to be a passive investor in real estate syndications, you need to join a community. You can't be successful, I don't think, doing it on your own. You need other people to share ideas with, to share operators, to share deals, to share knowledge, work together. I really think that's the only way to be successful. I tried doing it alone, and it didn't work out. And I just really think joining a community, again, I'm biased. It doesn't have to be left field investors. There's other communities out there. Get a network, go to conferences. You got to meet people. As weird as it is in today's world where we're on Zoom and doing all this stuff, it is a people business. It's a relationship business. And so you gotta make sure that you have those connections with people to help you get into investments that'll grow your wealth.
And just because people aren't in Ohio and aren't in Columbus doesn't mean they can't be part of what Left Field's doing, correct? You guys have online resources. You guys have your website. Do you guys hold Zoom meetings or something like that online for your get-togethers?
Yeah. We have a monthly meeting, the fourth Monday of every month, open to anybody. It's on Zoom. We also do 2 to 3 webinars a week, either presenting deals or lunch and learns. We have all kinds of content. Thank you for pointing that out. We have people from coast to coast. In fact, we have people overseas. We got a guy who usually comes to our Monday evening. There's 7 p.m. Eastern time. And we're all having, a cocktail or something, and he's eating breakfast because he's living in China. So we have people from everywhere. Wow. Yeah, it's pretty cool.
Very cool.
But even that example shows how the walls have been brought down to be able to collaborate with people. So why wouldn't you? I mean, like, historically, if you didn't collaborate with somebody and try and lean on other people, it's because you couldn't. You know, like one of my first mentors in real estate was like, I just didn't have anybody, you know, to hold my hand and to follow. There weren't a lot of resources or books out like there are now. So it wasn't because he chose not to. It just wasn't as accessible. Nobody has that excuse anymore. Like
they don't. And you know what? If you don't find a community that works for you, start your own, right? I mean, I didn't intentionally do this. Now I have 1,300 friends who help me on all my investments. And before it was just me. So if you can't find one you like, start your own. Why not? You can do it.
Yeah, very cool. Before we just have a couple closing comments, I did want to ask you to speak to active investors out there who are maybe in the midst of deals right now or looking to scale their syndication business. From somebody who is kind of a professional LP, what would you say to an active investor? Just what advice would you impart to them?
Well, the thing we talked about this whole podcast, right? If you're going to be an active investor and you want people to invest in your deals, you need to communicate effectively. You need to not only be timely with your communications, meaning if I send you an email or phone call, you need to get back to me within a reasonable period of time, 24 hours. At least say, I can't get back to you, but here, I got you. I got your message, right? So communication is key, I think. And then also, don't be afraid to interact with all these communities that are out there, and not just don't go to a community and say, ooh, you got 1,300 members. What can I get from you?
Right.
Go to a community and say, what can I give to you? Because that will come back to you. And so, we have people that support us financially, our partners, they support us financially. And it's not a, hey, we pay you X and you give us Y.
Right.
It's we're partners. We're going to pay you money and we're going to expect something in return, but it's not going to necessarily always be equal. Sometimes I will win. Sometimes the other guy wins. That's how it works. So if you're an operator, effective communication, and then partner with people and give, because I've found, that abundance mindset, if you give, it gets returned to you. And it's shocking. It doesn't make sense, but that's the reality. And that's what happens. So that's what I would recommend to capital raisers or operators.
You can fight it, or you can just believe it and do it. So
exactly.
In closing here, what's been one of the greatest resources for you personally in your real estate career?
Again, this is going to sound like a broken record.
Community.
Besides community.
We got you.
Okay.
We got you with community.
You got me. I think just this is going to be similar, unfortunately. It's relationships. It's such a relationship business.
It is.
Really, you really need to, make those relationships with operators, with other people, with service providers, property managers, all these different things, because that's what's going to help you. And I know I kind of skirted around your don't use community, but that's it for me. That's what I do. And that's how I do it.
He's like, I'm not going to say community, but something more communal in nature.
Yes, exactly.
No, but you know what? The reason that you're so adamant is because it's true. And it's obviously been the most pivotal and crucial part of this whole thing. And that's been a recurring theme of all the guests that we get to interview. Even if you're saying a podcast, well, guess what? Someone's producing that content. A mentor, that's somebody. A mastermind group, like it is all people, and not recreating the wheel, humbling yourself to learn from someone else who knows something a little more than you do. Tell us about, you've talked about Left Field, you've explained the community. What would be the best way that somebody could actually participate? What does it look like to be a member of Left Field?
Yeah, so there's a couple different ways. The first thing is, if you want to just check us out, go to leftfieldinvestors.com. And then if you want to subscribe to our newsletters, which gets you access to a lot of the education, a lot of the deal flow, there's a button on the top right that says subscribe. Just click on that. You'll get emails from us. If you get tired of getting emails from us, click unsubscribe, and we won't hassle you anymore. Then we also have a paid community if someone really wants to dig in a little deeper and get access to our forum and some of the investor tools we have. There's it's called the Infield because of the baseball stuff, the infielder group.
Yeah.
So at the top of our webpage, there's an infielder login. And if you want to join, you click that. It's $200, $199 a year to join the Infield. So it's not a huge investment. But those are the best ways to interact with us. And then also we have a podcast, Passive Investing from Left Field, where we interview operators and other people in the business. So those are kind of the ways to connect with our community.
And the Passive Investing, that's from Left Field. That's a podcast, right? That's what you'd said?
Yeah.
So people
podcast,
can follow that.
Yeah, we do. 2 episodes a week. One is kind of, like I said, an interview with an operator, and the other one, Chad Ackerman, one of our other founders, does. He interviews maybe a community member or something like that. It's a little bit more focused than the other one.
Nice.
All of those things will be in the show notes as links for you to pursue further as you're listening to this. Jim, we are excited to have you on to speak to our passive investors and even to active investors on how to run a credible business and something that's going to be around for a long time. So thanks for taking the time to jump on today.
Well, thank you. This was a lot of fun. I enjoyed talking with you guys, and I hope we can do it again sometime.
Absolutely.
Awesome. As always, excited that you joined us on another episode of the Reinvest Podcast. If this episode added to your tool belt or left you feeling inspired, go ahead and share it with a friend. Stay tuned every Tuesday for new episodes. And if you want to get in touch with us, go to our LinkedIn or Facebook profiles and shoot us a message. Move farther, reach higher, and grow deeper. See you next time.